entire team at CNBC TV 18 gets you all the big stories of the evening. I'm Surabhi Upadhyay, and here's what else we've lined up for you on the show today. Well, straight to news that's just coming in. The International Monetary Fund has warned that risks to India's corporate sector and banks is only rising. The fund has released a staff report prepared on India's economic prospects. The IMF also has a word of caution to India Inc. and its dependence on external funding. However, the growth projection has been maintained at 7.3% for FY16 and 7.5% for FY17. Ritu Singh is here with more details. Ritu, as if we needed any more reminding, here's the IMF telling us that we've got a problem with bad loans.
Absolutely. I mean, this is on top of the Reserve Bank of India and the Finance Ministry constantly reminding us. But as you mentioned, the IMF has maintained the growth projection at 7.3% for this fiscal and 7.5% for the next fiscal, which is not much of a growth there, but mostly in line with what the government had estimated. This growth will be driven by a stronger domestic demand, although external headwinds remain, and those will be the key risks as far as our growth challenges are concerned. Number one challenge comes from the fact that the high household inflation expectations continue to rise. The second thing is the large current account deficit, which, because of the higher public expenditure and the expectation of an increase in wages, that remains a key macroeconomic challenge for the economy. Also, a continued weakness in exports, which have been declining consecutively for the past several quarters. These are some of the key macro challenges. But also on the domestic front, the corporate balance sheets, which remain highly leveraged despite several steps taken by the government. The report does acknowledge measures taken by the government to unclog the stalled projects, but it also warns that this will have a negative impact on the bank's balance sheets, and the NPAs that continue to rise may also pose a big threat as far as economic revival is concerned. Specifically, it said that there have been stress tests that it is conducted on the corporate balance sheets, and it expects a lot of the restructured accounts also to further fall into the NPA category, which is the bad loan category. It also raises the need for more capital requirement into this public sector banks. It has not given any key figure per se, but it does say that in the next 4 years, about 0.8% of the FY19 GDP is the amount of capital that the public sector banks may require. And lastly, as far as inflation is concerned, all said and done, because of these rising inflation and the food management controls and measures put into place by the government, the 5% CPI inflation target of the Reserve Bank of India does seem achievable at this point of time.
All right. Thanks, Ritu, for taking us through all of those important highlights. Well, from the IMF outlook, let's now move on to the Dalal Street action. After getting battered and bruised since the